Good day, students. I will be doing the 2014 exam, which I think this will be the last video for this term. Question 1 says the following pre-adjustment trial balance on the 31st of July 2014, the last day of the financial year, for Chisa Trading Stores has been provided. This indicates that the end of the accounting period is the 31st of July each and every year, and we are given a trial balance, and in the trial balance we are given the capital, drawings, equipment, accumulated depreciation, vehicles at cost. It means we have two assets, equipment and vehicles. We are given fixed deposit, again another asset, and a fixed deposit can be a current or a non-current asset. As I highlighted previously, it depends to the maturity date of the fixed deposit. If it matures in less than 12 months, it's a current asset. If it matures in a period more than 12 months from the end of the current year, then it is a non-current asset. We are given inventory, petty cash, bank. If you see, the two are supposed to be combined because all those are cash available in the bank. Trade payables, sales, cost of sales, debtors allowance. Debtors allowance is the amount or the value that was returned, the value of goods that was returned by the customers. So now this is more like sales return, in other words, sales return. It normally gets to be recorded in the debtors allowance journal. When we did subsidiary journals last semester, we accounted for this. We have, so now, sorry, that will mean that the amount of debtors allowance must reduce our sales. Here is the amount of the sales. Therefore, now this has to be subtracted from our sales when we do the income statement. We have credit losses, rent, electricity, salaries, and we have another income being discount received. This discount received will be under other incomes in the income statement, and there is interest on the fixed deposit, which is 12,000 rands, and we had a fixed deposit, but we don't know the percentage of the interest that we're supposed to receive out of the 120,000 rands. So now we have to check in the adjustments. So now these are just the major few things that I wanted to highlight before I begin to do the adjustments. Now I always say that before we read the adjustments, we first have to know what are we required to do. First requirement, we are required to prepare general entries for note number E and note number F, that is from the adjustments. So now we know that we have to do two general entries. 1.2, we are required to do the asset disposal. So now it means there was an asset that was disposed, and they say refer to note number D. So now if we go to note number D, because we can't just do asset disposal alone without other workings. Under note number D, it tells you that on the 30th of April, equipment with a cost. So now it means equipment that was costing 90,000 rands was sold. That therefore means that the asset disposal that they are referring to here is the disposal of equipment. So now it means I always recommend that we must also do the equipment ledger account at cost. So now it means we must have a ledger account as our workings, and we must also do the accumulated depreciation ledger account for the disposed asset. You don't have to do all this ledger account if the asset was not disposed. So now this will just be our workings, and this will just be another workings, because after the asset was disposed, we have to do the property, plant and equipment, that also affecting the disposal of the asset. Then under 1.3, we are required to do the statement of profit and loss, being the income statement, and 1.4 we are required to do the statement of changes in equity, and 1.5 we are required to do the statement of financial position at 31st of July 2014. So this tells you that we are at the end of the year 31st of July, or doing the books for the year that end 31st of July. 1.6 we are required to do the property, plant and equipment. So now this is property, plant and equipment note, the one that we know. So now, and since we know that the property, plant and equipment will be affected by the asset that was disposed, so now it means there is a link between the two, a link between 1.2 and 1.6. So hence I always recommend that we do the 3 ledger accounts, then after we shoot straight to the property, plant and equipment, then follow all other financial statements. Then after we are required under 1.7 to do trade and other receivables note, that don't think I'll have time to do it today. So now we have to start with the template, as I always recommend that do the template for all your financial statements, and do the template and do the ledger accounts for specifically the asset that was disposed, and also do the template for the property, plant and equipment note. So that's always I recommend students to use that strategy, because it just makes things easy. So now I have drawn beforehand the structure or the template of the income statement, starting with the sales. Then from sales I've done my cost sales, cost of sales, gross profit. Under my other incomes, remember in the total balance there was a discount that was received. So now I took that discount and I recorded the amount of 4,020. Remember, from the total balance there was a discount that was received. Discount received is treated as income, 4,020. So now I made a provision for that, 420, and just make a provision because there might be a profit or a loss on the disposal of the asset. So now I just made a provision for the profit because I already know that it is a profit on the disposal. However, when you are not sure, you can also make a provision under expenses for the loss. Remember, there was also interest on the investment. There was a fixed investment, so now I also made a provision for that. And the interest that was already received on the investment, it was kept in the total balance or recorded in the total balance, and the interest on that fixed deposit is an amount of 6,000 rands. Therefore now it means we can just record it here, just open here brackets 12,000 rands, so that if there is something to add or subtract, we will do that with respect. So now we continue with the template. Under expenses, credit losses, we had an amount of credit losses given to be 3,300. Wages and salaries are given there, salaries and wages 403,890, and I record that 403,890, just recording all the amounts that are already given, Depreciation, we still have to account for that. Rent is already given, took the amount as it is from the total balance. There is 117,000 rands for rent. Credit loss, it was 3,300. So just make sure that you keep record of what is already there. Then similar with the statement of changes in equity, you can just write the structure for that. And balance sheet, we know that the amount of the property, plant and equipment will come from the PPE note. So now we have not yet done the note, but we just structured that. We know that there is a fixed deposit, but we don't know either is it a non-current or a current asset, because if it matures in a period more than 12 months to come, therefore it will be a non-current. But we don't know, but I've made a provision because I already know that the maturity date of this fixed deposit was more than 12 months. So now it means it will be a non-current asset. Under current assets, I have inventory, trade, and other receivables, and my bank account, and I've written the amounts as they appear in the trial balance. Inventory 507, 105, as you can see the amount of the inventory here on top. The inventory 507, 105, yes, cash in the bank 47,400. And cash in the bank, obviously we must account for the 5,700. We must add that because it is already the 5,700. Then after we go to under equity and liability, equity will come from the statement of change in equity. The amount that we'll get here will be the one recorded under the equity in the balance sheet. Then now we come to we don't have any long-term loan. I've just browsed the trial balance. There was no long-term loan in the trial balance. We only had a short-term loan. Short-term means current loan, 32,295, and I have accounted for that in the statement of financial position, recorded that as 32,295. And trade and other payables are also given in the trial balance, and trade and other payables in the trial balance are given to be 136,500. So now I just recorded the amounts as they appear in the trial balance. So now after that, you also have to have the template for the ledger accounts. These are the ledger accounts for the asset that was disposed. It's very important to be able to do these three ledger accounts for the asset that was disposed. And remember, we have already ascertained that or seen that the asset that was disposed was under note number D, the equipment costing 90,000, sold for 69,600. I'm just randomly going through those. I'll still go in details. So these ledger accounts are for the asset that was disposed. Then after, here is the template for the property, plant, and equipment. So now we have prepared everything. Then now when we go to the adjustments, we can just read the adjustment and we record it where it is supposed to be recorded. And to say that, fortunately, your exams, most of the time you will be given the template. Sometimes they will just want you to complete in the details, but the template will just be given there, maybe blank. Sometimes it will be filled, then you might just fill in the missing cells or columns. So now I will just go to my adjustments or additional information. Then as I read the information, I will record that immediately, and this is always my strategy. Under the first note, note number A, they're telling us that a debtor who owed us 1,980 cannot be found, and his debt has to be written off as irrecoverable, obviously. So now this is the debtor who was unable to pay us. We traced him, he was nowhere to be found. Amount is 1,980, and whenever that is a bad debt, it must go straight to the income statement and in the balance sheet. It means under our credit losses, we have to say plus 1,980. And because this person is a bad debt, therefore now it must be removed from our debtors, being our trade and other payables. We must say minus 1,980 because it is no longer a debtor in the business. So now if, let us say, you had to do a general journal for this, just for you to understand, it was going to debit bad debt. Remember, bad debt is an expense. It will be bad debt 1,980, and we credit our debtors. Remember, debtors are assets, and assets increase on the debit side. So the minute we credit our assets by 1,980, it indicates that it has to be a negative. Hence, this is a minus 1,980 because our debtors would have been credited if we had to do a general journal. So our debtors are bad debt sold is an expense is debited, and expenses are increasing. Hence, in the income statement, this is recorded as a plus of 1,980. So now I have completely recorded this entry. both in the debit side being the income statement and the credit side being the balance sheet. Then now I go to note number B. Note number B says allowance for credit losses at 5% of the outstanding debtors. They always highlight outstanding debtors has to be created. Remember, this data is still within the books of the business. It means when we are calculating the allowance, we must say the amount of the debtors minus 1,980. Then after we multiply by 5% to calculate the allowance of the outstanding debtors by the end of the current accounting period. So now we need to go and check the amount of our trade and other receivables that sit in the trial balance. So now in our trial balance, we have an amount of trade receivables being 149,175. So now we have to subtract the 1,970, then we say minus 1,980. And if you say 149,175 minus 1,980, that will give us an amount of 147,195. Then times this by 5%, it will give us an amount of 7,360. I rounded off to the whole number, please. Otherwise, there are decimals. I decided to round off to the whole number. So now this is the amount of the allowance at the end of the current accounting period. So now this allowance must be compared with the allowance, if any, in the trial balance. But if you check in your trial balance, there is no allowance for credit losses that was already recorded. It means in this case, the full amount of 7,360 must be recorded in the income statement, and the full amount of 7,360 must be recorded in the statement of financial position, reducing our debtors as 7,360. Under the credit losses, it must be a plus 7,360 rands, because we assume that this amount will not be received from our debtors. And at the same time, if we assume that it will not be paid, therefore now we assume that we are not going to receive this, it must be removed from our debtors as 7,360. So now we are reducing our debtors with the assumption that this amount will not be paid from one of the debtors or some of our debtors. Therefore now we have accounted for the allowance both in the income statement and together in the balance sheet, which is the 5% portion. So now we can continue with number C. Number C says interest of 7,500 must be provided on the short-term loan, which is unsecured and payable in full on the 31st of December 2014. So now remember, we are doing the books for the year that end 31st of December 31st of July 2014. This is the end of the accounting period. 6 months down the line, it will be 31st of December 2014, the end of the normal year. So now they are telling us that the loan will be paid at the end of the current year, indicating obviously that that loan is a short-term loan. Hence, that 32,295 was obviously recorded as a short-term liability. And besides, it was stated in the trial balance that this is a short-term liability. There we had our short-term loan of 32,295. So now there is a link with this question paper. So now they are telling us that we must provide for the interest expense. It means this interest is the interest for the year. And if we go to the trial balance, there was no interest expense that was paid. You can look all the expenses here. There is no interest on the loan that was paid. And you can go up, there is no interest that was paid. So now it indicates that the interest of 7,500 is still accrued. It's not yet been paid. Therefore now it is also the interest that was supposed to be paid. So it means 7,500 will be an interest expense and 7,500 will be recorded as a liability, because there is no sign in the trial balance, or there is no record or any amount that indicate that a certain amount of the interest on the loan was paid. Therefore, now it means that by the end of the year, the business is fully liable to pay 7,500. So now 7.5 will be recognized under current liabilities as a plus 7,500 because it has not yet been paid. And at the same time, the 7,500 must be recorded in the income statement under the finance cost, which is the interest on the loan, as 7,500, because we are told that 7,500 is the interest to be provided for the year. So now once again we continue. So it means we have recorded this on the debit side and recorded it on the credit side. Remember, the debit side being interest expense, credit side being accrued interest expense. Let me just show you another journal entry if this was to be recorded in the general entry. It will be debit interest expense 7,500 because it was not yet paid. It will be credit accrued expense 7,500. Remember, accrued expense is a liability. So now that is why this is recorded as a plus under trade and other payables. So now the debit side has been accounted for and the credit side has also been accounted for. Then now we can go to note number D, and note number D is the one that tells us about the disposal of a specific asset being equipment. Note number D says that on the 30th of April, remember the accounting period ends on the 31st of July, but they say on the 30th of April, equipment with a cost of 90,000 rands. So now this is the cost of this equipment was sold for 69,500. Remember I said in the previous question paper, the price or the amount at which an asset is sold or disposed is recorded in the asset disposal on the credit side. So now this amount will be recorded on the credit side of the asset disposal because it's the price or value by which equipment was sold. However, this is the cost of this equipment, and the cost of the equipment will be recorded on the credit side of the equipment ledger account. So now they are telling us that it was sold for cash. That means the contra entry under the asset disposal 69,600 will be recorded as the bank because it was a cash disposal. This equipment was bought on the 1st of August in the year 2011. That is very, very important. It was bought on the 1st of August in the year 2011. So now if it was bought on the 1st of August 2011, remember the end of the accounting period is 31st of July each and every year. So now on the 31st of July 2011, it was the end of 2011 accounting period. On the 31st of July 2011, it was the end of 2011 accounting period. So now any transaction that took place or any transaction that occurred after this date, it was for the 2012 accounting period. Hence now we are seeing here that this asset was bought on the 1st of August in the year 2011. So now the 1st of August was the beginning of the 2012 accounting period. It means this equipment was bought at the beginning of 2012. Therefore now it will be in the business for the year 2012, 13, and in the year 2014 it was sold. So now we are not going to count the year 2011 because it was not in the business by 31st of July, but it was in the business on the 1st of August, beginning of 2012 accounting period. So now you will see that when I calculate it soon. This entry has not yet been recorded. So now it means the disposal, which is this disposal of 69,600 of the equipment that was costing 90,000 rands, has not yet been accounted or recorded for in the books of the business. Then they say another equipment with the cost of 42,000 rands that is included in the trial balance was purchased on the 1st of November 2013. So now remember, the 1st of November 2013 is within 2014 accounting period, because the 2014 accounting period started on the 1st of August. So now from the 1st of August until 31st of July 2014, this is 2013. From the 1st of August 2013 until 31st of July 2014, that is the 2014 accounting period. So now any transaction that occur between the 1st of August until 31st of July 2014 is for the 2014 accounting period. And we see that the equipment that was costing 42,000 rands was bought on the 1st of November, and the 1st of November is between these two dates. So now it means it was bought in November, then we have to calculate the number of months from November until 31st of July in the year 2014 when it comes to the depreciation of this new equipment. Then after now we continue again, and they say, take this into account. They say the 42,000 rands is already included in the balances. So now it means the amount of the equipment that we see in the trial balance, this amount, equipment cost 192,600, it includes the cost of the equipment that was bought during the year, and that equipment costing 42,000 rands is already there. Therefore, now it means when we are doing the ledger account for equipment, that must be removed in the opening balance because it was not there, but it must still be recorded in that ledger account on the debit side. Then after, they are telling us that according to the company's policy, depreciation on equipment has to be provided on the straight line method over an estimated useful life of 10 years, and vehicles are depreciated based on the diminishing balance method on or at a rate of 15%. These are the vehicles per annum. However, equipment is the straight line method over a useful life of 10 years. So now we are seeing in this case the disposal of the asset, and we are seeing the purchase of the new asset being equipment costing for 2,000 rands on the 1st of December in the year 2013, and we are seeing the disposal on the 30th of April 2014, which is just a couple of months before the end of the year, and that equipment was costing 90,000 rands, sold for 69,600. So now we have to account for this disposal of the asset, and we start in the ledger accounts, then we transfer that information to the property, plant and equipment. So now let us start with our ledger accounts, and we see how far can we go with this question. Equipment at cost must be, first have to record the balance on the debit side, and the balance on the debit side of equipment is from the trial balance. But in the trial balance, take into consideration of the fact that an equipment costing 42,000 rands is included there. An equipment costing 42,000 rands is included. They clearly stated that under note number D, that another equipment with a cost of 42,000 rands included in the balance was purchased on the 1st of November. Remember, 1st of November was during the current year. So now it means when we are doing the opening balance, we have to say the 192,600 of the cost of the equipment minus 42,000 rands, so that we get the value of the equipments that were in the business before the beginning of the current year. And if you do that, you get to 150,600 rands. That will be 150,600 minus 42,000 rands is equal to 150,600. So now this is the cost of the equipments that were in the business by the beginning of the current year. So now we go to our ledger account and we record that opening balance as 150,600. Then after, we have to record or recognize the equipment that was bought during the current year, because it was not there in the beginning of the year, so now we can't record that in the opening balance. Then we say banks/creditors. Remember, this was recorded, we just acknowledging that as an asset bought during the year. Then after, now we have to recognize or record the equipment that was sold, and we know that the equipment that was sold was costing 90,000 rands. Then the contraint will be asset disposal. Asset disposal. And there was no other equipment that was purchased or either disposed during the year except the 90,000 and the 42,000 rands. So now if we go there down, we see that 90,000 is the cost of the sold equipment, and 42,000 rands is the cost of the new equipment bought during the year. So we have recorded those one respectively in their correct signs. Then from there, we can record now the total of the equipment, and the total of the equipment will be 192,600. 192,600. Then after, now the balance at the end of the year will be an amount of 102,600, which is the balance carried down, that will be brought down. Balance carried down, balance brought down, 102,600, that will be balance brought down. So now that will be the balance at the end of the year for the equipments. Therefore, now we have to come to the accumulated depreciation for the disposed asset being equipment, starting with the balance on the credit side. The balance is always on the credit side. And the opening balance from the trial balance, it is given from the trial balance as 67,410. There is the opening balance for the accumulated depreciation on equipment, 67,410 rands. 67,410 rands. So now we have to account for the depreciation for these assets. Depreciation for these assets. Now, if you remember in the adjustment, we were told that an equipment that costed the business 90,000 rands was disposed, and if it was disposed on the 30th of April, it means it was disposed before the end of the year. Therefore, now the depreciation for this equipment must be recorded on the date of the occurrence of the transaction. So if the transaction occurred on the 30th, it therefore means that it must be recorded on the 30th of April. So now we have to count for the number of months. Remember, the 2014 accounting period started on the 1st of August. 1st of August 2013 was the beginning of the 2014 accounting period, and this will end on the 31st of July. So now this asset equipment costing 90,000 rands was in the business on the 1st of August until 30th of April, somewhere there, 30th of April. So now we are calculating months from the date the asset was bought until, so from the beginning of the year until the date the asset was sold. Beginning of the year was the 1st of August, and the asset was bought on the 30th of April 2014. It means if you count the number of months, it will be August, September, October, November, December, January, February, March, April. Therefore, now that will be 9 months. So now that means the depreciation for the current year for the sold equipment will be for 9 months. 9-month depreciation for the sold equipment from August 2013 until April 2014, the date in which this asset was sold. So now we have to calculate the depreciation for the sold equipment for the current year. Depreciation for the sold equipment. We are calculating depreciation for the sold equipment. So this is for the sold equipment, and the cost of the equipment that was sold is given to be 90,000 rands. there is no residual value that was given, then we just divide by the useful life of 10 years. That will give us an amount of 9,000 rands, which is depreciation for the full year. Then after we divide by, sorry, we times by 9 months out of the 12 months, then that will give us the depreciation for the equipment that was sold. 9,000 times by 9 over 12 gives us 6,750. 6,750. This is the depreciation for the equipment that was sold, and that depreciation must be recorded separately because this asset was disposed on a separate date, and its depreciation was recorded on the date this equipment was sold. Then after we have a new equipment that was bought. New equipment was costing 42,000 rands. So now we have to record that equipment. So we have to record depreciation for the new equipment. The new equipment, we know that it costed the business 42,000 rands. And we know that useful life is 10 years, and that will give us 4,200. That will give us 4,200. And it was in the business from the 1st of November. So now from November until the end of the accounting period, we must count the number of months. It was in the business from 1st November 2013. Then it will be December, January, February, March, April, May, June, July 2014. Therefore, it's 1, 2, 3, 4, 5, 6, 7, 8, also 9 months. So now it was in the business from the 1st of November until 31st of July 2014, the end of the current accounting period. That is 9 months. So now we also have to say times by 9 divided by 12. Then this will give us the depreciation for the current year for the new equipment. Therefore now we have to account for that, which is 3,150 rands. Therefore now we are done with that. Let us check if are there any other equipments that were in the business, because there might be other equipments that were not sold that remained in the business until the end of the current year. Let us check from our trial balance if the trial balance tell us anything. So now in the trial balance we have the total of all the equipments, including the one costing 90,000 rands that was sold, including the 42,000 rands, because we are told that the cost of the equipment costing 90,000 rands is already included in the trial balance. This one is already there. And we obviously know that 90,000 is there because we know that this entry was not yet recorded. That means the disposal of this asset was not yet recorded in the books. It means all the cost of this equipment, which was bought on the 1st of August, it is still in the amount in the trial balance. So now let us establish if are there any other equipment that were in the business. So now we have to say 192,600 minus the disposed equipment 90,000 rands and minus 42,000 rands, which is the new equipment, so that we can check if are there any other equipments that were still left in the business. 192,600 minus 42,000 rands minus 90,000 rands. It gave us 192,600 minus 42,000 minus 90,000 rands. This gives us 60,600. So now after we have subtracted the sold equipment from the total cost and subtracted the new equipment, we still see that there are other equipments that were in the business. There are other equipments that were in the business. So now it means equipments that costed the business 60,600 were not sold. So now they were there in the beginning of the current year until the end of the year. It means we also have to account for their depreciation, because we did calculate depreciation for the sold one. It was 9 months in the current year, and we did calculate depreciation for the new one that came on the 1st of November, and it was for 9 months. But now, what about those that were in the business that were not sold and they were in the business from the year that we don't know? It means we must also calculate their depreciation until the end of the year for the full year. So now we have three depreciation: the sold one, the new one, and the old one, or the remained one. So now the old ones are costing 60,600, and we know that they were in the business until the end of the year. So now it means they were not sold. So therefore now their depreciation will be for the full year 6,060. Therefore now we have to add the two 3,150 plus 6,060. That will give us the depreciation of the two equipments, of the equipments that were in the business until the end of the year. Then we have a separate depreciation for them because these two were recorded at the end of the year. Their total is 9,210, which is made of 3,150 plus 6,060. Then after now we have to remove the total depreciation for the asset that was sold on the 30th of April, which is the one that costed the business 90,000 rands. That must be removed on the debit side of the accumulated depreciation. This equipment that was sold. So now we know that it was bought on the 1st of August 2011, and I mentioned that this 21st August 2011 is the beginning of 2012 accounting period. Therefore now if that is the case, it means now we have to calculate the depreciation of this asset from the year 2012, year 2013, and 9 months for the year 2014. And we already know that for 2014 is 6,750, which is for the year 2014. So now let me just highlight there and circle that and say it's for year 2014. So now we start in the year 2012, which is from August 2011 to 2012. Therefore now we know that the asset was there in the business for the full year is 90,000 rands. Divide by 10, that gave us 9,000 rands. It was there for the full year 2011, 2012, and 2013 it was there for the full year. So now if it was there in the business for the full year, then that means it will still be the same 9,000 rands. So now this equipment costed the business 90,000, was there for full 2012, therefore full 2013, there in the business in the year 2014 only for 9 months. That cost, that amounted to 6,750. So now if we add all the three, 6,750 plus 9,000 for the full year 2012 plus 9,000 for the year 2013, that will give us the total accumulated depreciation for the sold equipment until the date it was sold, and that will give us total accumulated depreciation as 24,750. So now this is the total accumulated depreciation until 30th of April when the asset was sold. That means from here we can calculate the carrying amount, even the profit or the loss. Carrying amount is the cost of the asset, and the cost of the asset is 90,000 rands minus accumulated depreciation of 24,750. That will give us the carrying amount of this equipment on the date it was sold, and the carrying amount is 65,250, which is the value of this asset on the date it was sold. But we have noted that this asset was sold for 90,000 rands. See there on the white page, 90,000, 69,600. That was the price the asset was sold, 69,900. So now if you see the selling price is bigger than the carrying price, the carrying value. So now if the selling price is bigger than the carrying value, it therefore means that a profit was made on the disposal of this asset. There we have 69,600, and the difference will be a profit, 69,600. Therefore now there will be a profit of 4,350 that was made on the disposal of this equipment. So now we can immediately capture that profit, although it will still appear in the asset disposal ledger account. Let us just immediately record that in the income statement, 4,350 rands. Profit on disposal, 4,350. So now let us continue with our calculations. We were already done with the calculation of the depreciation for the current year. Therefore now we were about to record the total accumulated depreciation for the disposed asset, and the total accumulated depreciation, we have seen that it is 24,750 from the year the asset was bought, 2012 accounting period, up to the year the asset was bought, 30th of April 2014. That is 24,750, and the contra entry will be asset disposal. Therefore now we can balance this ledger account, and we give the total of the credit side, 67,410 plus 6,750 plus 9,210. That will give us 83,370. 83,370, 83,370, and to subtract the amount of the debit side of 24,750, that gave us 58,620. Therefore now we get to have the balance carried down, and balance brought down will be 58,620. That will be a balance brought down. So now we have calculated the profit or the loss. Remember, although I almost forgot this, we were told that this entry was not yet recorded. This entry was not yet recorded. It means the selling of this asset, 69,600 for cash, was not recorded in the bank as increase. It means our bank account must still increase by 69,600 because it was not recorded in the books. Therefore our bank must be increasing as an asset on the balance sheet. So now we go to the balance sheet, we say under bank plus 69,600 rands. Then from there we have captured this in the balance sheet section, then we must capture that in the asset disposal again. So now let us just go and do our asset disposal ledger account, and we know that on this side we record the cost of the asset that was disposed. Equipment that was disposed costed the business 90,000 rands. Then we also know that on this side we must record the total accumulated depreciation. Total accumulated depreciation of 24,750 for the asset that was sold. There we have 24,750. Then after we record the price at which this asset was sold, and the price at which this asset was sold is 69,600. There you can see that it was sold for 69,600, which is the price or the value. The contra entry will be bank because it was sold for cash. Remember, let me just link you back. We are not recording this under bank or either creditors because it was already recorded correct. The buying of this asset was correctly recorded. The reason why we remove it from there is because it was not there beginning of the year. So now we wanted to separate it, record it separately. The contra entry doesn't mean that our bank or creditors must be generalized. No, that is a different case because the recording of this asset was recorded correct and accurate. It's only the disposal of the asset that was not recorded correctly. Therefore, now we record the calculation of either a profit or a loss. Then we have to calculate first the total of the credit side, 24,700 plus 69,600 gives us an amount greater than 69,600 plus 24,750. That gave us 94,350. That means the credit side is bigger now, and you always write the total of the bigger side, 94,350. So now in this case, we obviously have made a profit. You minus 90,000 on that, and you see that there's a profit of 4,350 profit on the disposal. And I think this profit is the same as the one that we have calculated. So now we can say profit on the disposal. There in my calculations, I showed a profit of 4,350 there, 4,350 profit on disposal. And again, the ledger account reflected the same thing. So there is definitely an agreement between the two. From the ledger accounts, the minute you are done with the ledger accounts that affected the asset that was disposed, then you can immediately do the property, plant and equipment. Then cost will be 150,600, which come from the ledger account 150,600 opening balance. Then we record the opening balance of the accumulated depreciation 67,014, opening balance negative 67,410, and that will give us the carrying amount of 83,190. 83,190 for equipment. Then after we come to the section of the movements, we have acquisitions. Acquisitions is the purchase during the year. Therefore now here is equipment, 42,000 that was bought during the year, because remember we excluded or removed it from the opening balance 150,600. So now we recorded that in under the movements because it was acquired during the year. Disposals at carrying value, we are recording our asset at carrying value, and you know the carrying value is the cost of 90,000 rands minus accumulated depreciation. That gave us 65,250 as the carrying value. 65,250 is recorded there as the carrying value, 65,250. Then after now we have to record the total depreciation for equipment for the current day, total for the new equipment, sold equipment, and for the old equipment. So now the total of their depreciation will be the sum of the two, the sold one, the new one, and the old one. Therefore now the sum of the two is the 6,750 plus 9,210 will give you 15,960 rands, 15,960 rands. Then after the cost at the end of the year is given from the ledger account of the asset, there is the cost at the end of the year. Here the cost, it was balance carried down from there, it was brought down same amount, 102,600 cost at the end, 102,600. Then accumulated balance at the end of the year is in the accumulated ledger account balance. There it is 58,620. It was carried down there, brought down here. 58,620. 58,620. 58,620. So now that will give us the carrying amount at the end of the year as 43,980 friends. Therefore, now we come to motor vehicles. Motor vehicles were not sold, and there was no purchase of motor vehicles. And whenever that is the case, everything just becomes easy and very, very straightforward. Remember, we were told that the calculation of depreciation in the motor vehicles is diminishing balance method and is calculated at 15% per annum. So now we first have to start with the cost of our vehicles. The cost of our vehicles is given, and that cost is 279,000 rands. Because there was no purchase, opening balance will be equal to the closing balance, 279,000 rands, and the closing balance will be the same, 279,000 rands, because there was no addition, either a disposal of the asset. Opening accumulated depreciation is given in the trial balance, and the opening accumulated depreciation is 146,475. 146,475. So now that is just the opening accumulated depreciation. Then the carrying amount beginning of the year is 132,525. Then we know that there was no purchase, there was no disposal, but we need to account for the depreciation at the end of the year for our vehicles. So now let us just account for that depreciation for the vehicles. Now our vehicles, we know that their cost is 179,000 rands, and the depreciation will be 179,000 minus 146,475. We are doing it for vehicles. 179, is it 179 or 270? Okay, sorry, it's 279,000 minus accumulated depreciation of 146,475. So now we just have to say 279,000 rands minus 146,475. Then that will give us 132,525. Then we times that by 15% because they told us that motor vehicles depreciate at 15% diminishing balance method. So now 15% will give us 19,000 or 19,880, 19,879, already rounded off, 19,879, 19,879. I've already rounded off that figure. After that, the decimal was 75. So now we can just say opening accumulated depreciation plus depreciation will give us closing accumulated depreciation, and that will give us closing of 166,354, and the carrying amount at the end of the year is 112,200 or sorry 646. Then after we can just totalize that. Total under the cost is 429,600, 429,600. Then after we have 213,885, and we have carrying amount as 215,715. Then we have 42,000 rands here, and we have negative 65,250, and our total depreciation will be 35,839, 839. Then after we will have total cost at the end of the year as 381,600, and total accumulated at the end 224,974. Total carrying amount will be 156,626. So this amount will go straight to the balance sheet under property, plant and equipment. Straight to the balance sheet under PPE we record 156,626. So now we have captured that aspect, which is the major part of the question. Then from there we can continue with the statements that were given. So we have done number D, then we are doing number E. Number E says interest on the fixed deposit is calculated at 10% per annum and has to be provided. Fixed deposit will mature on the 31st of December 2016. So now it means it will mature in the next 2 years because we are doing the books for the year end 31st July 2014. 15 and 16 is 2 years. Therefore, now the fixed deposit must be recorded as a non-current asset. Therefore, now the amount of the fixed deposit of 120,000 rands must be recorded under our non-current asset because it will mature in the next 24 months or 2 years. Then from there we can calculate the interest, and let us calculate the interest from the 120,000 rands. Therefore now we just have to say 120,000 rands times by 15%. We know that the interest is calculated at 15%. Then we just say 120,000 rands times by 15%. That will give us the actual amount that was supposed to be received, and that will be 18,000 rands. This amount straightly go to your income statement as the interest income. So now we know that we're supposed to have received 18,000 in the income statement. So now if we're supposed to receive that, let us record what we're supposed to receive. Interest on the investment is 18,000 rands that was supposed to be received. It means obviously there is an amount of 6,000 that is accrued, but let us confirm if it is 6,000, so that when you say 12,000 plus 6,000, it has to give us 18,000, which is the interest that was supposed to be received. Now if you see, we have calculated that the interest on this fixed deposit is supposed to be 18,000 received, but in the trial balance we only received an amount less than that. The interest on the fixed deposit is 12,000 received instead of 18,000 rands. So if you say 18,000 rands minus 12,000 rands, you will see that there is a difference of 6,000 rands. Therefore now 6,000 rands is accrued interest expense, and we were required also to do the general journal for that entry. So now we have to debit interest, accrued interest, because accrued interest income is an asset. So we debit accrued interest, which is an asset, accrued income by 6,000, and we credit interest income. By an amount of 6,000 rands. So now that should indicate that accrued interest is an asset. Therefore now our debtors or our assets must be increased by 6,000 rands in the balance sheet, because we have already recorded the 6,000 where the interest income is increasing on the credit side. This is the interest income increasing on the credit side by 6,000 rands. So now let us record the 6,000 of the accrued interest income to the balance sheet under the asset section, under our trade and other receivables, we have to say plus 6,000 rands. Then we continue slowly with that question. So we have recorded that the debit side plus the credit side. Then we come to number F. Rent was paid up to 31st of August 2014. The rent cost per month remain unchanged during the year. So now it means the amount of the rent in the total balance is paid for 13 months. So now if you see that the rent 117,000, you divide by 13, it will give you the amount of rent that was paid on a monthly basis, because it is paid up to next month. So now we say 117,000 rands divide by 13 months, that will give us an amount of 9,000 rands. So 9,000 rands will be recorded as prepaid because we paid that before time. Prepaid because they are telling us that the rent has been paid until 31st of August. Remember, the accounting period ended 31st of July. So if we pay up to 31st of August, it means the prepaid expense. And the prepaid expense is an asset. Therefore, now the 9,000 must be increasing our assets in the balance sheet under trade and other receivables, plus there on top 9,000 rands plus 9,000 rands. We add that because it is prepaid or paid before time. Then now we have to record that again in the income statement, because any prepaid expense by the end of the year must be removed from our expenses, minus 9,000 rands, because we don't need any expense for next year in the current year. Then after now we can go again to our adjustments. So now we have captured this adjustment both in the balance sheet and in the income statement. So now let us come to the last adjustment. The last adjustment says an amount of 2,145 still outstanding on electricity has not yet been paid by 31st of July 2014, and they say and has to be provided for. So now it means in an amount of electricity by the end of the year was not paid. That means we have an accrued expense, and accrued expense is a liability. So now it means we have to debit electricity by 2,145, and we credit accrued expense. Accrued expense being a liability, just L, therefore a liability. So now we have to increase our liabilities and increase our expenses by 2,145. Obviously it will be our current liabilities plus 2,145 rands. So now we have to go to our income statement, and we record that in the income statement, and we have to say plus 2,145 in our expenses. Here is the expense for electricity plus 2,145. Let us check if we do still have another adjustment to take into account. No, that was the last adjustment to take into account in this exercise. So now let us immediately go and balance everything from the income statement, and we balance everything with regard to the equity statement and the balance sheet, and see if does everything work together. So now we start in the income statement, and in the income statement we have acknowledged that there was debtors allowance that was supposed to reduce our sales. We had an amount of sales which was given to be 1,443,750, and there was an amount of debtors allowance which was returned by debtors, which we said that must reduce our debtors, because when the debtor return something, it has to reduce the debtors or the sales. So now 1,443,750 minus the debtors allowance, 1,443,750 minus the amount of debtors allowance is given to be 27,750 minus 27,750, 27,750. That will give us the amount of sales as 1,416,000. 1,416,000. Let me just wrap this for neatness purpose. Otherwise, we must show that in brackets. Cost of sales are already given in the trial balance as for 534,000 rands is the amount of cost of sales, 534,000 rands, 534,000 rands, and our gross profit will be 882,000 rands. Then after there was no adjustment regarding a discount, therefore now we can record that 4,020. Then after we can calculate the total, and the total is 26,370, which is the total of the other incomes. Then after we can totalize our credit losses, and our credit losses will amount to 12,640, 12,640. And wages and salaries, there was no adjustment, 403,890. Then after we will have our rent expense that amounted to 108,000 rands in total, 108,000 rands. And our electricity will amount to a sum of 5,175. And our depreciation will come from the ledger, from the property, plant and equipment note. We have done that, and our depreciation is the 35,000 is the depreciation, 35,839, 35,839. So that will be the amount of depreciation, 35,839, 839. Make sure that expenses are always negative. Your expenses are always negative. Then after we have the finance cost. Then after we have to add all of our expenses, including the finance cost, and if we do so, that should give us 565,000. There under our expenses, let me just erase this for space purpose. For space purpose, just erase that. Therefore now under our expenses we will have 565,544 total expenses, all of them, from credit loss up to the finance cost. Now we have to say gross profit plus other incomes minus expenses. That will give us profit for the period, and the profit for the period will give you an amount of 335,326. 335,326 will be in the equity statement. 335,326, straight as it is. Therefore now we are already doing the statement of changes in equity, and we start with the opening balance. Opening balance normally will be your capital amount if you do have the capital, and the capital amount is given in the trial balance. In the beginning we are given a capital amount. There is the capital of 817,500. 817,500. Then we take into cognizance or record the amount of the drawings. And remember, there was no adjustment regarding drawings in the trial balance. Therefore, now the amount of drawings, as you can see, 270,000 rands. We take that as it is, minus 270,000 rands. Then from there, now we can have the closing balance of our statement of changes in equity, and that closing balance will be 882,826, and this amount will go straight to our statement of financial position under equity as 882,826. Therefore, now we have to totalize everything, totalize our trade receivables, totalize our bank, totalize our inventory, and inventory there was no entry, so we can just record that inventory as it is, 507,105. We have recorded that part. Therefore, now we have to account for the total trade and other receivables. And our trade and other receivables are 154,833, 154,835. Then our bank, we have to add the three amounts. Plus 69,600. That will give us 122,700 total of our trade and other receivables. Therefore, now we have to continue adding the sum of our current assets plus 154,835 plus 507,105. That will give us a total of 784,640. Then total of our non-current 156,626 plus 120,000. That will give us 276,626. If we add the 278 for 640, that will give us 106,1266, 1,061,266. So now let us come to our equity and liability. Our total will be 136,500 plus 7,500 plus 2,145. That will give us 146,145. And our short-term loan, same, 32,295. Our total current will be plus 32,295, which will be 178,440. And if we add our equity plus our liability, this amount plus this, 178,440 plus 882,826 plus 882,826, we get 106,1266, and that 106,1266, it agrees with our assets. 1006,1266, 1006,1266. Therefore, our balance sheet balances. With that, I think you will be almost prepared enough to go and write your exam. Therefore now I can close this exercise because it is complete. Thank you.